The risk of loss in trading futures and options can be substantial. Therefore, only genuine risk funds should be used in such trading. Futures and options may not be a suitable investment for all individuals, and individuals should carefully consider their financial condition in deciding whether to trade. Option traders should be aware that the exercise of a long option will result in a futures position. Information herein has been obtained and prepared from sources believed to be reliable. Comments contained in these materials are not intended to be solicitation to buy or sell any of the commodities mentioned. Past performance is not indicative of any future performance. Opinions expressed here are the opinions of the author only, and not the opinion of any firm the author may be affiliated or associated with.
Welcome back to Commodity Classics. I'm Michael Yorba, your host. Thanks for joining us. My guest this segment is Tony Cherniawski. We're talking about the Dow, and we're going to get into some other markets, but let's bring in Tony right now. Tony, before we get back into the topic at hand, let me alleviate some pressure on the shout box, and I'll get some of these questions answered, okay?
Sure.
All right. First one, you're talking about the patterns, ABC, corrective waves, and impulse waves for the Dow Jones Industrial. And we have a question here that says, let's see, could it be an ABCDE pattern instead of an ABC?
Okay, let's answer that one first. First of all, an ABCDE pattern is associated with a triangle. And the answer is no, we're not seeing a triangle. Triangles are pretty obvious to the casual eye. So, usually the pattern will just pop right out. Every once in a while, the pattern might be, have just a little bit of an off squiggle or something like that. But there is no ABCDE pattern here. What's interesting, I'll just point out that in the NASDAQ, we had a triangle pattern back in February, I believe, and it was a B wave of a smaller ABC pattern. So in other words, we went down an A, we had an A wave up, a smaller degree A wave, and then an ABCDE triangle, and then a C wave out of that. So that pattern itself was that is usually it means that the pattern has an end to it at some point, and because the C wave ended up on the NASDAQ, what that meant was this bearish wedge, which was the C wave, was the ending, and final extension of that pattern. So in that respect, we do occasionally see ABCDE patterns, triangle patterns, and they tend to tell us that there is an end in sight. There's one more wave up or down. And by the way, Mike, that was one of my little secrets when I called the top in gold back in March, because late February and early March, there was a triangle pattern. And if you remember right, I think I called the top in gold on March the 13th, and the gold actually topped on the 17th. And it was because of that triangle pattern that says, hey, there's only one move left here. When it's done, it's done. And that's the same thing that we had in the NASDAQ in February, which said, hey, this market isn't going higher. This ABCDE pattern says there's one more flip up. Usually the C wave has some equality to the A wave or some relationship to the A wave, and then we go right back down again. So we see no such pattern right now at this point. Go ahead with the next question, Mike.
Okay. Real quick on this one, what about those internet rumors of a coming economic collapse in September?
People have been talking about that for a long time, and I haven't seen the ones relating to September, but let me just suggest this. I run into different theories, and one theory that is a possibility is that we could go down into September. Well, actually, it'll be November, December of this year, that there will be a final bottom to this big decline. I don't think so. I think that the powers that be will really want to pull out all the stops going into the election. And it doesn't matter who gets elected, whether it's a Republican or Democrat. So I'm not trying to say one way or the, sway the election in any way. But I think that our politicians do not want to see a down market during an election. That would be just an ugly sight. And the problem with politicians at that point is they always point fingers and argue about who's to blame. So I don't think that that's going to happen. What I think will probably happen is that we're going to bottom out sometime this summer. And I'm going to give it to the June to July time frame. It's going to get ugly, but it should improve a bit into the fall and maybe even into the first part of next year.
Okay. Aussie Pete, friend down under in Australia, who gets up early to watch this show. Thank you very much, Aussie Pete. No, I really appreciate people getting
a loyal viewer, yes, sir.
from Australia. Is that stochastic or RSI at the bottom of your chart?
I use a slow stochastic, and mainly the slow stochastic is exactly what the name implies, that it's slow. And it's a confirmation indicator more than anything else. I have another set of model criteria that I use to judge the tops and the bottoms and you know where the market should go. That's something that's a bit different, and I don't tend to show those on the air. So I will often use the MACD and the slow stochastic and a few other of the classic indicators, classic oscillators, and it's good to use more than one anyway. So usually the slow stochastic just simply confirms. By the way, what I like to do is I like to use some type of fast stochastic. I'm not going to. There is such a thing as a fast stochastic. I don't use any of the ones that are in the common charts here. I have another one that I've developed, and the slow stochastic sort of, you know, because these faster stochastics tend to jump around a lot, I use the slower one to kind of keep me more steady in my judgment of where the market's going.
Right, and I noticed you've got a hook on there.
Yes, sir.
It's a classic signal. Let's get to the next question. I want to get back into these charts here. What do you say about some very reputable Elliotticians counting October 2007 high as a wave 3 instead of 5?
You know, Mike, the answer to that is it depends where you started counting. And that is a real issue because some people start their count at the bottom in 1982, others start in the bottom in 1974. You know, I'm not going to take sides on that right now, but, you know, let's let the market tell us which way it goes. What I have just said on the Dow head and shoulders pattern and so on is that the up wave is done. We've already seen wave 5. That's what I'm saying right now. But I'll tell you what, I'm not married to that view. If we stop at 11,600 and don't go down any further, then yes, we're going to see some more highs.
Okay. All right. All right. I'm just happy to see this this shout box. They're just talking amongst themselves in this shout box. You go right ahead, buddies. When you get a question for us, come at me with the question. I'll relay it here to Tony. All right. Let's go to this next one. You got a what is this? A 30-year T-bond fund?
Right. It's the TLT. It's an exchange-traded fund. It's the 20-year plus Treasury bond fund put out by Lehman Brothers.
Okay.
And I don't see the mint green quite as well on my screen as maybe some of the other people do, but I thought, hey, I'll put different colors on my charts here. What we're looking at is an expanding triangle, which is bearish. So ultimately, the larger picture on bonds is bearish, especially the long bond. However, one of the things that happened, and it's somewhat evident on the chart there, is that we had a low in early May at 90.62 on the TLT, and then the low was retested successfully. So what that means is that we have an up wave here coming up very, very shortly, and it may have already begun. And what I wanted to say is, you know, people ask me, are you bearish on everything? And I say, no, there's as a famous pundit has said many, many times, there's always a bull market somewhere. I think in the next 3 weeks or so, as the stock market declines, I think there's going to be a rush to safe haven investing in bonds, and I think we're going to see the long bond being a beneficiary as well as the 10-year bond. So what I believe is going to happen, what my model tells me, is that we may have a rally up to about 95 or 96 in the TLT. As of yesterday's close, it was at 92.5 roughly. So it's not a huge move, but it's better than putting it in cash. So what I'm saying is this move itself, it's a trade. It's not a buy and hold situation. But I believe that we're going to see, at least in the initial slide in the stock market, we're going to see bonds being the beneficiary of the safe haven move.
More so than metals?
Yes. Yes. In fact, let's
clear that up.
Let's get to that next.
Okay, but before we leave this part, now I've never traded in this bond fund, but it's the same concept as bond futures. It's an inverse relationship to yield. The price goes up, interest rates go down.
That's right.
Okay.
That's right. Now, the TLT is the actual, it's not an inverse, it's an actual bond ETF. So what you're doing is in effect, you're investing in the equivalent of the 20 or 30-year bond here. So what this is saying is that bonds will be the beneficiary of the sell-off in stocks in the next several weeks.
Now, let's come back to Tony for a second, Don. I've got a question here, only because I don't know much about this investment vehicle. Is there a minimum investment to get into this bond fund?
In the TLT?
Yeah.
No, not at all.
Okay.
Not at all.
So if I threw $100 in it, and let's say it's at 92 today, and
right.
it went to 96, how much money would I make?
You're talking about almost a 5% return in the next 2 or 3 weeks.
Okay, that's what I wanted to know, about 5% on my money in 2 to 3 weeks. This is a trade, not an investment. Would you look, when it hits their 96 objective, do you feel comfortable? Can you short this thing?
Yes, you can. The symbol for that is TBT.
Okay.
Okay, so there is a short bond fund that you can use at that point. I would not hang on to it beyond, let's say, 95 or 96.
Is there leverage or is it zero leverage?
I don't believe either of these have any leverage at all.
Okay, that's good enough. All right, let's go on to the next one because we've got about 3 minutes left for you, and I want to get through these things.
Oh, yes, and this one's going to bring me some hate mail. I got some this morning, by the way, already. So, and what I like to do.
Hey,
is
welcome to public access TV.
That's right.
That's all right.
What I do is I try to let the charts tell me what's going on here. I try not to keep a predisposed notion of where things are going. Now, understand that I've been bearish on stocks for some time, but you can also say, okay, here is a counter trend move. We know that it's going to go a certain distance. All I'm saying is that the bigger picture is still bearish, and I'm saying that on gold right now too. In fact, I submitted this chart yesterday, and it's already sold down, and I don't remember what the amount was. The last I looked at it this morning, gold was down about 5 or 6 points already.
Oh, the gold market?
Yes.
Front month futures down $9.60.
There you go. There you go. And what I said last night was that as of yesterday's close, it was done going up. Remember that, Mike?
Yes.
So the point, and again, there's little secrets. It takes a while to get used to the notion that the market is rules-based. There are certain things that can go on. And when I say rules-based, there are the general rules that you can follow, but every once in a while the market takes a weird turn. So, for example, the general rule on this rally in gold was that it should have gone up to about 915 or so. Instead, it went to 932, 933. Well, 915 happened to be, for me, it happened to be a resistance level on my model, and it also happened to be the 0.618 retracement of the decline that occurred here from 946 down to 956, down to 846.
Right.
The point is, so, what happens is every once in a while you say, okay, here's the general rule. You can short it at 915. In fact, that's what I did, and lo and behold, the short went bad on me. We make mistakes on this, but what's the alternative? Okay, well, you have to, when you see that, you cover, you go back and say, what happened here? In this case, the final alternative is the 0.786 retracement, which happened to be where gold went. It stopped dead on the 0.786 retracement, and it did it within a certain period of time, which is typical for a C wave. And, you just kind of add the information together. And I said, last night when I sent this in, I said, I'm sticking my neck out. I could be wrong, but here's my call. I said, in fact, I'll read this. I want to point out.
Well, no. We're out of time. We're over by a minute. But let me wrap this up real quick, Tony.
Sure.
New target, $650 an ounce. Are you getting the feeling right now that we are at, if I was to call this 5 on the chart down from 1,000 to 846, that what happened as of yesterday, or meaning the high,
Right.
we could be at the end of wave 2 and now start our next leg down towards 650? Is that what you're thinking?
Exactly. In fact, this is a third of a third, Mike, and it could be quite strong. And I don't know where this total move is. I haven't made it out. What I've done is I've just done a target. And by the way, this is also 38.2% decline from the high. So if you do your little Fibonacci calculations, actually I think the 641 is the 38.2% decline from the high. Okay. So again, we've got the same kind of pattern as we do in the Dow and some of the other indexes as well.
So we're going to see if we can call a hat trick here, 3 in a row?
Yes, sir. Let's try it.
All right, Tony, thanks for showing up. We'll see you next week.
Thank you, Mike.
You got it. Tony Cherniawski, the practical investor. He'll be back next week this time. Michael Yorba here on Commodity Classics. Up next, Tim Boss. Sit tight. More exciting stuff to come.